One of the places people look for information when making investment decisions is the financial media. But with its inevitable focus on stock market volatility and where the markets might be heading, the media can be a distraction from what you really need to think about.
You cannot predict what a market's going to do. You can't. And if you miss out on the big up days, it seriously impacts your long-term performance. What those two facts tell you, buy and hold. Buy and hold. Buy every month, pound cost averaging, every week, whatever it is. Pound cost averaging, buy regularly, that is the way to do it. So ignore what the news tells you, follow the academic research. Buy and hold regularly, save, put your money away. Forget about what the market does. It's interesting from a news perspective, utterly irrelevant from an investment perspective.
That's not to say you should ignore financial news altogether. Apart from anything, it's very interesting, but you shouldn't let it guide your investment strategy.
So I consume the news, I look at share prices, I look at what's going on. It has no impact whatsoever at all on how I invest. At all. I look at the economies, I look at the markets, I look at all of it. Does not stop me doing what I do, which is every month money goes into my pension, every month money goes into my children's, future savings, every month money goes into my husband's pension. We don't change the fund we're in. We're always in the same fund. I read it all, I find it fascinating, I love it. No impact on how I invest at all.
Another problem is that low-cost passive investments receive far less media attention than actively managed funds. The reason is that fund management companies spend large amounts of money on PR and advertising.
The other thing I don't think the media truly understands is passive is not trying to blow the lights out. Because you blow the lights out one year and have amazing performance, but then the next year you have terrible performance. That's how active works, generally, okay? So in any given year, passive is very unlikely to be one of the top performing funds. But it doesn't need to be. That is the point. Average, year after year after year after decade, will blow the lights out over 40 years. You don't need to blow the lights out. The whole point in passive is it's never going to make the top of a performance chart because it's not what it's trying to do. It's not what it needs to do. So that is another thing. Ignore performance charts for funds, and yet they are everywhere.
In short, financial news might be entertaining, but from an investment point of view, it may be less useful than you think. The sooner you start investing, the more you'll benefit from the power of compounding in the years ahead. If you're not already doing so, the single most important thing you can do for your future financial well-being is to get started. Here at TEBI, our preferred investment platform for UK investors is InvestEngine. It's cheap and easy to use, and you can be up and running within minutes. What's more, TEBI viewers who start investing with InvestEngine receive a welcome bonus of up to £100. The minimum initial investment is £100. To claim your bonus, click on the link in the bio or YouTube description, or just use the promo code TEBI.